This is your Wall Street wake-up call. The European Central Bank leaving key interest rates unchanged and making no changes to its bond buying program. For more, I'm joined now by Christopher Wright, a cross-asset strategist at UBS Asset Management, with me now from Zurich. So Christopher, the ECB dropped hints at its last meeting in July that there may be more action coming, but nothing this time around. Are you surprised?
No, essentially what they did today, which was nothing, leaving their main rates unchanged, making no changes to the technicalities of their QE program, was what we expected. We felt that they would remain in a bit of a holding pattern for the next few months, essentially waiting to see or get a little bit more data on the impact from the UK referendum. But also, we've seen some fairly encouraging data out of the Eurozone over the last couple of months. I think one that's probably gone a little bit unnoticed is the inflation data. Been increasing for a few months now, so I think that's clearly a positive for the ECB and something that's keeping them on hold for the time being.
Although, do you think it's too early to gauge the fallout from Brexit, if there is any, for the Eurozone?
Yeah, I think so. I mean, obviously early signs, particularly on the sentiment side of things from the business sentiment, has been better than some had feared in the UK and the Eurozone. But I mean, it's still early days. UK hasn't triggered Article 50 yet. It's still obviously in the EU. So you know, clearly a long path ahead to see the real implications for the Eurozone economically there.
Now, the ECB is buying 80 billion euros worth of corporate and government bonds. There's this issue that the ECB is running out of bonds to buy because it can't buy certain bonds that yield below the deposit rate. But isn't one reason we're seeing yields in Europe, you know, at zero or negative yields across the board because of ECB stimulus? Aren't they causing their own problem?
Yeah, they're certainly driving this hunt for yield across the Eurozone, which is essentially bringing more and more yields negative further out along the curve. And some people had expected a little bit of a technical change to their QE program because of that issue you just raised. We didn't hear any announcement from it today, though. So I guess right now they're not too concerned by it. But I mean, it may be something that is adjusted down the line because they can actually make that technical adjustment to the QE program at any point.
But it doesn't QE become less effective when you have yields where they are now in Europe, either zero or in negative territory?
Yeah, I mean, QE came in and it was extraordinary monetary policy, and it's been going on for so long now that it's almost not becoming extraordinary anymore. We need more extraordinary policy if you're going to have an immediately positive impact. But I'd reiterate the point that there are some underlying positive trends in the Eurozone. So, you know, it probably is having not a super hard, fast impact, but it is having a positive impact. And like I said, on the inflation data, you are seeing it starting to come through now, keeping yields low. You are starting to see a little bit of loan growth in the Eurozone as well. So these are all kind of positive, sustainable trends that we should expect to continue over the coming months.
All right, Christopher Wright from UBS in Zurich, thank you very much for joining us. We appreciate it.
Thank you.
I'm Scott Gamm, and you're watching The Street.